Opendoor Technologies. What a week. What a stock. What a story. We're heading through Thursday's trading session, and while the broader markets are drowning in red ink, Opendoor is holding strong, sitting around $8.92 a share, down about 4.5%, but honestly, that's nothing to sneeze at considering how rough the day's been across the board. And the thing is, this pullback might actually be setting up the next big move. Because here's the reality. Opendoor has just come off 4 straight sessions of massive gains. We've seen 20% up, 5% up, 7% up, and now, finally, a bit of consolidation. The chart looks alive again. The volume looks real. And more importantly, the story behind the stock keeps getting better. Let's start with the headline everyone's talking about, the Warrant dividend. A few weeks back, Opendoor dropped a surprise announcement that every shareholder of record as of November 18th will receive a dividend of tradable warrants. It's called their Shareholder First Dividend, which, let's be honest, sounds like a PR consultant's way of saying we're giving you leverage. But here's the part that's just too perfect to ignore. These warrants come in 3 series, the Series K, the Series A, and the Series Z. Yes, you heard that right. K, A, and Z. Together, they spell the CEO's name, Kaz. You can't make this up. Now, was this intentional? We'll never know for sure. But let's be honest, if it was deliberate, it's genius. Because it's not every day that a CEO literally brands a shareholder reward program after himself. It's almost poetic. Imagine being a short seller trying to explain this to your fund manager. Yeah, I shorted a company where the CEO's name is literally printed on the dividend I now have to pay out to shareholders. That's got to sting. But jokes aside, the symbolism here is actually kind of perfect for what's happening. Kaz Nejatian has come in with serious conviction, and this whole KAZ warrant structure almost feels like a statement. Like he's saying, you want alignment? Here it is. I'm not just the CEO, I'm embedding my name in the upside. Now, here's what makes the structure so clever. For every 30 shares you hold on November 18th, you'll receive 3 separate tradable warrants. One Series K with a strike price around $9, one Series A at $13, and one Series Z at $17. Each of them gives you the right to buy Opendoor stock at those levels in the future. In other words, these are real, valuable financial instruments. Not gimmicks. Not NFTs. Not loyalty points. Real warrants that could be traded or exercised if the stock runs. And that's why investors are suddenly paying attention, because this isn't just a feel-good shareholder gift. It's a mechanism that rewards holding. It's designed to build loyalty and reduce turnover, and maybe most importantly, it puts pressure on short sellers. Because if you're short this stock heading into the record date, you're on the hook for the equivalent value of those warrants. You've got to pay that dividend out to whoever lent you the shares. And that creates what we call structural squeeze conditions. It tightens the float, raises the borrow cost, and makes it a lot riskier to maintain a short position as we approach November 18th. So what we're seeing right now could be the calm before the next wave. After 4 positive sessions in a row, the stock's consolidating a little, but with the record date now just over a week away, there's a clear incentive for investors to accumulate shares and hold through that date. And it's not just retail. The pros are paying attention too. Remember, earlier this week, CEO Kaz Nejatian himself bought roughly $1 million worth of stock on the open market, his first opportunity to buy since becoming CEO. That's about 125,000 shares at market price. It's a strong signal. He's not talking about confidence, he's showing it. And that's exactly the kind of leadership move that gets the market's attention. So when you put all of this together, the KAZ warrants, the insider buy, and the macro backdrop, you start to understand why this stock has defied gravity while most of the market's been rolling over. Now, let's talk about the short squeeze theory that's bubbling up again. Short interest is still elevated, around 21% of the float. That's a big number. But what's more interesting is the timing. Because right now, you've got a perfect alignment of events, short interest still high, borrow costs rising, CEO buying stock, and a shareholder reward that penalizes shorts if they stick around too long. That's the kind of setup that could create a slow burn squeeze, the kind that doesn't happen overnight, but builds day by day as short sellers quietly unwind positions rather than risk a blow up. And it's not like this is happening in a vacuum. The macro environment is starting to tilt in Opendoor's favor. Softer job data last week boosted the odds of a rate cut next quarter. Lower rates mean cheaper mortgages, which means higher housing turnover, and that's the lifeblood of Opendoor's business. Remember, this company doesn't need home prices to skyrocket. It just needs homes to move. Its entire model is about liquidity: buying, renovating, selling, and repeating. So when the market starts to thaw, Opendoor's transaction volume and revenue scales with it. That's why this week's performance has been so important. The stock isn't just reacting to one catalyst. It's responding to a combination of macro relief, insider confidence, and structural alignment with shareholders. The narrative has shifted from "Can Opendoor survive?" to "Can Opendoor scale?" And that's a much more comfortable story to tell. So what's the play here heading into the afternoon and beyond? The key level to watch is $9. If Opendoor can hold support above that area into the close, it keeps the short-term uptrend intact. A close below 9 wouldn't be a disaster, but it might signal a few days of consolidation after the recent run. On the other hand, if it holds strong while the rest of the market's down, that's another clear sign of accumulation. And honestly, that's the real story here, the behavior beneath the surface. Because even on a red day, there's demand. There's belief. And after 4 straight green sessions, a little breathing room isn't just expected, it's healthy. So if you're making a video today, the best angle might be this. Opendoor's Kaz Warrants. The CEO just put his name on the dividend, literally. It's funny. It's attention-grabbing. And it's true. You can use that humor to pull viewers in, and then unpack the serious implications behind it. Because the story isn't just that a CEO bought shares or that the stock's been rallying. The story is that he's re-engineering the relationship between management and shareholders in a way that actually rewards belief, while punishing doubt. It's a bold move, and whether it was intentional or just a cosmic coincidence, the fact that the warrants literally spell out KAZ is just the icing on the cake. It's almost too poetic. The guy's name is literally the ticker for shareholder alignment. So as we head toward the close, keep watching that $9 line. Keep watching volume. And keep watching sentiment online, because this narrative is starting to spread fast. And if there's one thing markets love, it's a story that's both funny and fundamentally strong. This could end up being the kind of moment people look back on and say, "Remember when Opendoor's warrant spelled the CEO's name?" Yeah, and remember what the stock did next.